Welcome, everyone. Welcome, welcome. Can everyone hear me? Please send your messages in if you can hear me. Welcome, everyone. Welcome. Welcome, welcome to Virginia Webinars. This webinar is titled Understanding the Financial Statement Cycle. The focus for today's webinar is on understanding the relationship between the three primary financial statements. I'm very passionate about this subject as it is super relevant to all businesses, and a fundamental understanding about how the financial statements work together is critical in any area of business. My name is Farid Saadeh, and I'm excited and I'm excited to share with you my key takeaways from my long experience working as a financial consultant with clients in this region, where I help them develop business plans, valuations, and financial models for their organizations. Over the next 45 minutes or so, I will be going over a few slides, after which I'm going to open up the floor for your questions. I will also be answering your questions as we go along with our slides. So please feel free to type your questions in the Q&A chat box or the chat window on your screen as I go along, and I'll do my best to stop periodically to answer your questions, okay? I hope you enjoy this webinar, and I look forward to hearing from you. So, again, my name is Farid Saadeh. I'm a senior financial consultant with the Virginia Institute of Finance. I hold the certificates, the AFM1, as well as the CERT IFR. The AFM1 is the Advanced Financial Modeler Certificate offered by the Financial Modeling Institute. It's a wonderful certification for anyone who may have some interest in financial modeling or business planning. It's a really wonderful certificate to go through. My experience is very heavy in finance, where I've been an investment banker, I've been a private equity associate, I've been an investment analyst, and I've been a consultant from valuation to business and a financial modeler by trade. Anyways, you can find a complete bio on myself at our website, viftraining.com. So just a few housekeeping issues before we begin. This webinar is being recorded. You will receive the recording via email after the event, and you can rewatch it at any time at our website in our e-learning section of our website. You can go directly to it at elearning.viftraining.com. Again, regarding the Q&A, I will try and answer your questions as we go along, but please feel free to send them in as we go. I will try to stop every 10 or so minutes, although I cannot promise that, just depending on how we're doing. If there are any technical issues, please feel free to send them in the chat. I'll do my best to alleviate it immediately. And you will receive your certificate along with the recording after the webinar. You can see more of our webinars at viftraining.com. We have many, more specifically, we do have a webinar recorded for the AFM1 prep. So if you are preparing yourself for the AFM1 exam, this the sort of preparation webinar is already posted there. It is a good summary of how you should go about tackling the exam. So I will just leave that for you there. So today we are talking about the cycle of the three financial statements. So let's just take a step back and understand what we're talking about. What we're going to be talking about are the income statement, the balance sheet, and the cash flow statement. Now, before we talk about the relationship between them and the effects that one change on one of the statements has on the other statements, what I want to do is I want to take a step back and actually, from a high level, discuss what each of the statement does, and it's their key sections. So let's start with the income statement. So the income statement essentially is essentially lists all of the company's revenues and expenses that the company has incurred over a period of time. This period of time can be a month, a week, a day, a quarter, and most commonly a year. It shows all of the revenues and expenses that the company has incurred over that period, both cash and non-cash, and essentially we're leading down to our profitability. So let's take a quick look at the three most important components of the income statement. Now, the first section of the income statement is the gross profit. So this is the company's direct profitability on its sale of goods or services. So essentially what we're looking at here is revenues less cost of goods sold. So whatever we sold less the direct cost that it took to sell those goods. For example, if we sell, if we're a bookstore and we sell books, our sales will relate to the sale of the books, and our cost of goods will be what it costs us to purchase those books. And the gross profit essentially is our alpha. It's what we're able to keep after we pay off those expenses. Now, the second component or critical component of the income statement is the operating profit. Now, this is the profit that the company has been able to generate from its core operations. So what we're doing here is we're taking that gross profit, the profit we're able to generate after paying for the cost of our goods and services, and we are now paying for all of the operational expenses that it takes to run the business. This includes sales salaries, this includes staff salaries, this includes utilities, rent expenses, and so on and so forth. Essentially, it's a big catch-all for all of the direct expenses that are realized or experienced during that period of time. Okay. Now, between operating profit, or after I should say operating profit, we have our last major component, and it is net profit. Net profit is our bottom line profit number for the period that we are reading the income statement for. This includes our net profit is essentially our take home after we have paid for our cost of goods sold, which are up here embedded within our gross profit, and all of our operational expenses, which are embedded within our operating profit. And the main components between operating profit and net profit include any sort of other income or expenses, like one-time gains or losses, as well as any interest expense and any zakah or taxes that have to be paid or incurred or provisioned for, I should say. So our net profit is our final take home. Now, something to mention, the income statement is filled with a lot of holes. There are a lot of non-cash items that are embedded within our costs. For example, the largest and most common non-cash item is that of depreciation. So depreciation is essentially the use of our long-term assets, such as the use of our machinery or our equipment or our furniture. And what we have to do is we have to essentially realize that the use of those long-term assets over time. And we do that through depreciation. So our depreciation is embedded in here. Additionally, other non-cash expenses like end of service benefit and zakah provision or income tax provision are also on the income statement. So those must be adjusted later. So now let's go ahead and talk about the balance sheet. So as you can tell from our wonderful little image here, the balance sheet has to do with a balance, and that balance must always, it must always be equal. Our resources or our assets must always be equal to our liabilities and our owner's equity. Essentially, we are if you want to think about the balance sheet in a more simplistic method, it is what we own, our resources, and how we funded them, our liabilities and our equity. For example, if what I own is a building and that's my only asset, I had to pay for that building in one way or another, either through a loan, through liabilities, or cash through equity, or some combination of the two. Simply put, the balance sheet must always be in balance. Now, some key balance sheet items or categories are our current assets, fixed assets, intangible assets, current liabilities, non-current liabilities, and finally our equity. So our current assets are anything that must be converted into cash, that can and will be converted into cash within a year, or used up. The benefit of those assets will be used up. The most common current asset is cash, as well as inventory and accounts payable. Our fixed assets are our assets that will be used for the long run. Long run meaning anything in excess of 1 year. So a common fixed asset is our equipment, our machinery. If I own a cafe, my coffee machines are my fixed assets. If I own a manufacturing plant, my heavy duty machines and equipment are my fixed assets. I just saw a question that said, is it possible for the balance sheet to be unbalanced for any reason? And the answer is simply no. The balance sheet must always be in balance. Even if you are doing something that will, make your equity negative, your balance sheet must always be in balance. The assets must always equal the liabilities plus your equity. So no matter what, we will always have a balanced balance sheet. In fact, as you go about your careers modeling, if you actually go into financial modeling, you will realize that financial modeling is within financial modeling, I should say, the most critical task a modeler has is to balance the balance sheet. If the balance sheet is not balanced, that puts a huge question mark on the accuracy of the financial model. Good question. Keep them coming, guys. So next, let's talk about our intangible assets. So these are our long-term assets that are not tangible. For example, our ERP system could be one, our software. It could also be any sort of license or any license we may have, anything like that. It's anything non-tangible that we cannot physically touch. It could be rights to a mine, for example. That's a pretty common sort of intangible asset. And also there's an intangible asset called goodwill. Now this intangible asset, this goodwill is not anything real. It's more of a balancing mechanism that we use for our balance sheet, but that's not part of this webinar. If you have any interest in that, go ahead and look up goodwill, and it's a bit of a unique one. I see a question: is fame a non-tangible asset? What do you mean by fame? Would you mind elaborating a bit more? So as our attendee will go ahead. Fame of an enterprise. So do you mean if you mean popularity, then no. There's no real intangible asset for popularity, unfortunately. But the popularity of an enterprise, if it's a publicly traded company, can be presented, if you will, in the company's stock price. So that can be embedded within its premium of its share price, relative to its competitors. So that's how popularity can be sort of quantified. Good question. So let's continue. So with our non-current, now let's flip the script and talk about our liabilities. So within our liabilities, we also have current and non-current items. So our current liabilities are anything that we have to pay within a year. This is typically any short-term debt or any accounts payables. Our non-current liabilities are any obligations that we have to pay that are due in excess of a year. A common non-current liability is long-term debt. Now, finally, equity is the balancing of our assets and our liabilities. Essentially, our assets less our liabilities. So what we're doing here is our equity is the ownership percentage of our of our balance of our in relation to our assets. I'm sorry, I see a good question here. Can you give us a quick example on goodwill? Yes, absolutely. So, for example, if my bookstore, this bookstore that I was mentioning earlier, decides to buy another bookstore, whatever price I pay for that bookstore in excess of its book value, the equity value that's presented on its balance sheet, that difference will be essentially on my balance sheet, will be presented on my balance sheet as goodwill. So when I acquire that other bookstore, the rival bookstore, let's say that their equity balance, their equity value on their balance sheet was $1,000. If I paid $2,000 rather than $1,000 for this bookstore, I will have created a goodwill account of the difference of 1,000. So as you can see, there's no real dollar figure or anything real in relation to that goodwill. It's more of a balancing mechanic to keep my balance sheet in balance. Good question. So now that we've talked about the balance sheet, let's just take a look at it really quickly. So what we have here is a very simple balance sheet. And these are the 5 components, the 5 most important components of the balance sheet. So as you can see, our assets must always equal our liabilities plus our equity. We've already gone through this. Now we could rewrite this formula as assets minus liabilities equals equity. And in fact, this is what we talked about before. Regardless of which method you'd like to follow, the formula must always hold. Okay, now within our assets, we saw current assets and non-current assets of both fixed and non-fixed assets in nature. The non-fixed assets mainly being intangible assets. Our liabilities include our current and non-current liabilities, and our equity includes a few items, most commonly any capital, like share capital, any common stock, preferred stock, any reserves, and finally, the most important item in equity are retained earnings. Now, the balance sheet, the thing that's important to distinguish about the balance sheet that differentiates it from the income statement and the cash flow statement is the balance sheet reports values at a specific point in time. Now, these are values. These are not, these are values at that date of the balance sheet. It's not like the income statement where revenue is essentially an accumulation of sales over the period that the revenue is presenting. The balance sheet will give you the values that you hold, such as how much cash you have in the bank as of December 31st, 2020 or 2021, example. So a few things I want to talk about regarding current assets and current liabilities is the most important items within our current assets and current liabilities relate to our working capital. Now, our main working capital accounts are accounts receivable, inventories, and accounts payable. These 3 make up our working capital. Our accounts receivable are essentially the uncollected sales, the uncollected cash of our sales. Our accounts payable is our bills that we have not paid, and this is usually in relation to our inventory. So now let's move on to the cash flow statement. So the cash flow statement is the most important of all the financial statements. The income statement is very important because it measures our profitability, but it has its holes. The balance sheet is very important because it tells us our values, such as how much cash we have, and what the values of our of how much debt we own at that point in time. However, the issue with the balance sheet is these figures are for a point in time. Now, the cash flow statement reflects the actual cash movement that the company has actually incurred or what's actually happened over the period of time. So the first point I want to make is the cash flow statement is similar to the income statement in that it covers a period of time. Now, the difference between the cash flow and the income statement is if you want to think about it in a simplistic form, the cash flow statement fixes the issues presented with the income statement. So what we're doing with the cash flow statement is we are taking that net income figure and we are essentially removing all of those non-cash gains and expenses. And what we're doing with that is we are trying to get an actual cash flow from operations number. And that's actually the first section of our cash flow statement. Our cash flow from operations is essentially what we are able to generate from our core business, okay? And it refers to how much money the company has either made or spent on its business. Now, this includes our normal course of business, such as to my wonderful bookstore example. This would include all of the sales, all of the expenses that I incurred over that period of time, but now it's been adjusted for cash. Now, the second portion of my cash flow from operations is the actual changes in working capital. Now, I see a question, doesn't the balance sheet include the opening balance of the previous years? So what the balance sheet does is it just reports the balances at that point in time. Whether it's an opening balance or a closing balance depends on what you're looking at. So if I'm looking at December 31st, 2021, the values that I see in the balance sheet are the closing balances as of December 31st, 2021. If I wanted to see what the opening balances were, all I have to do is take my balance sheet of December 31st, 2020, and those figures actually become the opening balances. Now, if I'm looking at a balance, there's a caveat here. And the important thing to keep in mind is what is your starting and what is your ending point. If I'm looking at a balance sheet that ends December 31st, 2021, but my beginning balance starts in, or the previous balance sheet I'm looking at starts on or is as of September 30th, 2021, then my opening balance is now September 30th. It simply depends on what is your actual opening date and your closing date. So that's how you can differentiate. So back to the cash flow statement. So our second section of the cash flow statement is our cash flow from investing activities. This shows us how much money we have spent or made in regards to investing in our company, either internally or externally. Internally means we buy assets, we buy machinery, we buy equipment. We are able to expand or at the very least maintain our operations. And that is a cash flow from investing activities. Now, finally, our cash flow from financing activities is essentially cash flows from funding. This typically includes items like debt, any equity or stock, and also any dividend distributions that are paid out to the owners of the business. Now, each of these categories, the cash flow from operations, financing, and investing, we are essentially totaling up these figures to get a total cash flow from operations, total cash flow from investment, and total cash flow from financing. And we are summing the three up in order to get our net change in cash. So this tells us if we are making cash this year or actually spending cash this year. So these are the three important sections of the three financial statements. Now, let's talk about why we're here. We're here to understand the cycle. Now, I have although it looks a bit messy, it is a relatively simplistic cycle of our financial statements. And I'm going to go over them very quickly, okay? If this looks messy, don't worry. I have a solution that's going to put all of these arrows in a bit more of a readable view, okay? So let's start with the income statement. So what we have here is a very simple income statement. We have our revenues, we have our cost of revenues, or our cost of sales, and then we have our gross profit. Then we have our expenses, down to net income. So between gross profit and income, we expect to see operating income. Now, on our statement of cash flows, we have our three activities: our operating activities, our investing activities, and finally our financing activities. Within our operating activities, the first item is our net income, followed by our changes in working capital. In our investing activities, we have our CapEx, the investment that we're making in our company, whether it's to maintain or expand our equipment. And then we have our financing activities. And this is going to either be our proceeds from borrowings or can be repayment of borrowings, and any dividends that we may make. Additionally, we could also, within this section, we could also have any investment that the owners of the business have put in, the equity holders, whatever investment they have put in the business. All right, and then we have our change in cash, which again is the summation of our net cash flow from operating, investing, and financing. We have the opening cash, how much cash we started with, and finally the sum of those two items, our closing cash. Okay, now going to our balance sheet, we have our assets, which include cash, property, equipment, and all of the other current items we discussed previously. We have our liabilities, which include our long-term loans and our current liabilities, like our accounts payable. And then within equity, we have our capital and our retained earnings. All right, now let's take a look at the cycle, the relationship between them. So although this looks a little bit messy, if you understand the accounts within, if you understand the accounts within the statements, and also if you understand the logic of the statements, this isn't actually that complicated. So let's just start with our revenue. Now, we can receive revenue in one of two ways. We can receive it in cash, or we can receive it in terms of an accounts receivable or an IOU. Now, we know this is a very common practice in today's business world. So when we receive it in cash, there's no effect on the statement of cash flows or the balance sheet. But if we do receive an accounts receivable, we must create an accounts receivable account on our balance sheet in our current assets, and we have to reflect the uncollected cash in our operating activities. So basically, we have to reflect for the cash we did not collect from those sales. Okay. Now, our cost of sales has to do with our inventory. Now, our inventory is presented on our assets and our current assets. Okay. When we pay or when we account for our cost of goods sold, those inventories must be referred to on our income statement, but also we have to account for the changes in our inventory, whether we sold or purchased our inventory. Now, last but not least, we have our accounts payable. Our accounts payable is our outstanding quote unquote bills that we have to pay based on those inventories, based on the cost of our goods. And we're going to keep it simple and just refer to it as our inventories. So what we're doing here is we also have a current account under our liabilities that the change needs to be reflected on our operating activities, mainly within our changes in working capital. Okay, so don't worry about these three. We have a very nice example coming up that's going to really simplify the understanding of our accounts receivable, our accounts payable, and our inventory. So if you're confused, just hang tight. All right, so let's talk about our expenses and our costs. These are all of our other expenses, such as salaries, utilities, and so on and so forth. Now, typically at the end of the period, there's always a little bit outstanding, basically bills that have not been paid. And when this happens, we have essentially an accrued expenses or accrued, usually an accrued liabilities, accrued expenses that we have not paid that will show up on our current portion of our liabilities. And again, we have to reflect that change in our operating activities. Usually it's within our changes in working capital. Now let's take a look at our income statement. Now, the income statement links to two places. For one, it's the first item in our operating activities, but also it flows into our balance sheet in the equity section under retained earnings. The net income is the only item that links the income statement and the balance sheet directly, as you can see. Now, the second thing I want to talk about are those adjustments to the non-cash items that are presented within the income statement. On the operating activities of our cash flow, we have to adjust for those non-cash items immediately. So right after net income, we adjust for them. Then we adjust for our changes in working capital. Then we finally will be able to record our total cash flows from operating activities. Now, logically, we want our operating activities, our cash flow from operations, to be as large as possible. This is a really important thing for the health of a business. Now, from time to time, we can have positive investing activities and positive financing activities, but for the long run, ideally, we want to see very positive operating activities. Our investing activities, again, relate to our CapEx, our investment in the company. This CapEx, the CapEx on the cash flow statement is the actual spending that we have made in that period. The balance of those assets, what we bought, shows up under property, plant, and equipment on the balance sheet, our non-current assets or our fixed assets. Now, our proceeds from our borrowings under our financing activities relate to any debts we may have. They can be both short-term or long-term. On our cycle that we see here, we're just talking about long-term debts. And these can be both positive, this change on our cash flow can be either positive or negative, depending on if we borrowed money, which means it would be a positive figure, or we repaid our debts, which would indicate a negative figure. Now, last but not least, under our financing activities, we have our dividends. Our dividends is what we pay out to the owners of the business. And our dividends get paid out from our retained earnings. So in fact, if I were to think about this logically, my dividend, this arrow should be reversed. My retained earnings gets paid out to my owners in the form of dividends. Now, retained earnings is more of a plug. It's not an actual cash figure, but accounting-wise, in order to understand the relationship and the cycle of the statements, we pay out our dividends from our retained earnings. Although this does get reduced from our cash balances. And that's how we get our net cash flow from financing activities. And last but not least, our closing cash from our cash flow statement gets reflected under our current assets portion of our balance sheet. So that's the very first item that we have on our balance sheet. Now, let's see the cycle in a real life example. Yeah? I want to start a coffee shop, and I'm going to call it Fred's Coffee and Treats. All right. So what do we do first? Well, let's go through this step by step. We'll go through a pre-start, if you will, interpretation, and then we will see what happens as the months go on and we operate our business. Okay. So step one of any business is to raise funding. Okay, so let's assume we've created our business plan, we've visited some investors, and we were able to raise $200,000 for Fred's Coffee and Tea. Okay, now we did the math, and we have estimated that our initial or our startup investment, which is going to include any advanced rent we have to pay, any leasehold improvements, basically design, building the inside of our coffee shop, and any equipment such as the coffee machines, those deluxe coffee machines we have to buy in order to run a cafe. And last but not least, the purchase of our inventory, basically our coffee beans and our cups and napkins and all of those things. We have estimated it to cost roughly 335,000 riyal. Okay, so we have estimated, in order to be safe, and in order to have a little bit of cushion, just in case the business doesn't start up very well, the first month of operations, we are looking to get $400,000 or 400,000 riyal of funding in order to start our cafe. All right. So what we're going to do is we put up our first 200K, and we have gone to the bank and asked them to basically match our funding and put in another 200K, and we got it. So let's see what the effects are on the three statements. So all that we have done is raised $200,000 of our owner capital, so essentially share capital or owner's cash, and we have gone to the bank and gotten a 200,000 riyal of borrowing. Now, nothing happens on the income statement because there has been no sales. In fact, we are in October, and if you want to think about it, you can call this T0, time zero, month zero. The business has not operated yet. All we have done is injected $200,000 of cash from our account, and we've borrowed $200,000 from the bank. So as you can see here, we have 200,000. Sorry, I keep saying dollars, but I'm talking in riyal. 200,000 riyal in debt borrowings, which you can see on our cash flow statement under financing, and our borrowings under our liabilities. And we have $200,000 which we invested as the owners under common equity, as you can see in financing, and under share capital, that you can see under the equity section of our balance sheet. So in total, we have $400,000 that we injected. Our change in cash is a plus $400,000 riyal, and we have 400,000 riyal in our bank account. On our balance sheet, you can see we have 400,000 riyal in total cash. We have 200,000, which comes 200,000 from borrowings and 200,000 from our equity. And you can see the balance sheet balances, right? Total assets equal total liabilities. Great. So step two, what do we need to do? Well, we need to acquire a lease for the year. And we know that basically in order to pay for our rent, this has to be paid up front. So what we want to do here is we want to pay for our lease and we want to buy some equipment. Now, this is a typo. Our actual advance rent payment is 125K. It's not 200,000. So please disregard this 200,000 figure. But so the two things that we're going to account for now is we're going to pay for our rent for the next year, and we are going to buy some machinery and equipment, some furniture, some fixtures, and again, we are going to perform some leasehold improvements, basically getting the cafe to look like a cafe. So what does this look like? Well, let's look at the income statement first. Now, nothing happens on the income statement because again, we are not operational. We have not sold a single cup of coffee. We are still setting up the cafe, okay? And we're gonna assume that we can get all of this done in the month of October, all right? So before the end of the month, our business will be set up and ready to go. Now, let's see what happened. What changes occurred now? Well, we have that 125K of rent we have to pay today. And you can see that under our operating activities, we have prepaid our rent, all right? Now, because this rent is going to be incurred over the next 12 months, what we have done is we have created an account on our current assets called prepaid rent. And the amount is 125K. Starting next month, we are going to reduce this amount, this 125K, by 1/12. Okay, so we're going to divide this figure by 12. We're going to reduce the amount on our balance sheet every single month because we're going to incur that 1 month of rent. So that 1 month of rent is going to transfer to the income statement. We're going to expense it under rent. Okay, but for now, we don't have to worry about that. Now, the second thing we have to pay for are those machinery and equipment, the furniture, the fixtures, so on and so forth. And that costs us about 210K. So basically, we're spending 125K plus 210K in this month before the business has even started. Now, good thing we had that 400K that we invested before, because now after we pay for those, we are going to be left with 65K in cash at the end of the month. Now, that 210K in capex is going to appear in the property and equipment account under our long-term or non-current assets, as you can see here. Now, this property equipment will be depreciated over the life of those assets. Okay, so every month we are going to decrease this figure by a little bit because we're going to be using it for that 1 month. And the use of this property and equipment is going to transfer to the income statement under the depreciation account. So we're going to incur that expense on a monthly basis. So now you can see we have converted our resources, our assets, that 400,000 in cash into 125 into prepaid rent and 210K of purchasing property and equipment, machinery, furniture, fixtures, etc. The balance sheet still balances, and we have now $65,000 of cash. Now, let's go to the third item. Let's purchase those inventories, that coffee, milk, any materials, cups, straws, lids. Now, and that we have estimated, well, we have decided to put up 100,000 Rial into this. Now, nothing happens on the income statement again because we have not started the business yet, but we are purchasing this inventory because we need to start selling next month. So what do? First, our prepaid rent, we've already accounted for that. Everything that we discussed previously remains the same. The only thing that we're going to do is now we are going to buy inventory, and what we have been given is a credit account of accounts payable. So as you can see here, we have spent 100,000 on our inventory, but we were also given a credit term from our supplier of 100,000. So there's no change in cash, but we have two accounts that we have created. We have an inventory account of 100,000, and we have an accounts payable account of 100,000. Basically, our supplier has given us 30 days to pay for those inventories, and we are funding that inventory by this credit account. If you want to think about it, think of your accounts payable as a short-term loan, like a 30-day loan. We have to pay for those inventories in 30 days. All right. Now that the business is set up, everything is great. Let's talk about what happens on the first month of operations. So we're going to hire staff, and they're going to run the business for a month. We're going to sell coffee for a month, and we're going to incur and pay expenses for 1 month. So this time, something does happen on the income statement. So we have sold 178,500 Rial of coffee in month 1. We have direct costs of 84,000 Rial, and that gives us a gross profit of 94,500 Rial. We have operational expenses of 12,500 of utilities. We have that monthly rent that we have to incur. We have telecommunications expenses, sales and marketing, and finally, employee salaries. So our total expenses for the month total 67,417 outside of depreciation. Now, our total net income, because remember, we also borrowed money, so we have to incur some interest expense, right? We have a monthly interest payment we have to give to our lender. We have resulted net income of 25,000 Rial. All right, so let's see what the actual cash effect, because remember, depreciation is not cash. This is not a cash number. Another thing, this rent is not a cash number. We already paid our rent in the month of October. We are just incurring that rental expense in the month of November. So let's see what the actual cash effect is. So net income is 25,000. We have to add back those non-cash expenses of depreciation and prepaid rent. So we're going to add them back here. Then we need to adjust for our changes in working capital. We paid 16,000 Rial to our inventory to cover the cost of our inventory. That's outside of the cost here. That's embedded in our cost of sales. And that resulted in a cash flow operations of 21,000. So we recorded net income of 25,000, but we actually generated 21,000 Rial of cash. We have no investments to make because all of our equipment, our machinery is brand new, but we have to repay some of our borrowing. Remember, we borrowed 200,000 Rial of essentially debt from the bank. We have to pay back their monthly payment of 3,333 Rial. This results in a change of cash of 17,500, resulting pushing our closing cash to 82,500 Rial. That's a good month. Our cash balance, or I should say on our balance sheet, our cash balance is 82,500. We have we still have inventory of 100,000, which means that we probably purchased some inventory, but it's not reflecting here because it's the same amount as we had. And finally, our prepaid rent account has been reduced by the amount of rent that we incurred in this period, in this month. We can see our property equipment has declined by the amount of our depreciation, that's 1750, and our accounts payable have declined to 84,000 Riyal. Now, our borrowings have also declined by that principal amount, that 3333 figure on our cash flow. And our retained earnings have now increased from 0 to 24,667. Remember, the net income flows directly into retained earnings. So we can see our total assets equal our total our total shareholders' equity plus liabilities. So we're good to go. Now let's move into the second month of operations. All right. So what's happened here? This month, in our second month, the month of December, we have our cafe has become a hit. In fact, one of our regulars has come up to the owners, to us, and has asked that we cater their monthly team meetings. So we said, okay, and this is a wonderful push for our business. So what's happened? Well, now we have our normal operations. Everything is the same as the month before, except we now have provided a catering service. And the catering service is going to amount to 50,000 Riyal in sales. So how is this going to work? For one, our sales is going to increase by 50,000 Riyal. Our cost of goods sold, our cost of sales are going to increase by the cost that it took us to generate those 50,000 Riyal. Everything from utilities down to interest expense remains the same, okay? And our net income has actually gone up by nearly 25,000 Riyal. That's essentially the profit that we're generating on that catering service, all right? So nothing has really changed, except we have a new line of service, which is wonderful. Now let's take a look at the cash flow. Our cash flow includes that net, it starts with that net income, but we need to adjust again for those non-cash items. And we need to adjust for that accounts receivable, which we have which we have generated from that catering service, because we have given the business that we're doing catering for an accounts receivable. We have given them they have given us an IOU. Basically, they're going to pay us next month, which is perfectly fine. But now we have to adjust our net income by removing that 50,000 Riyal from our sales because we did not receive it, which results in our total cash flow from operations of 37 odd thousand Riyal. All right. Now there's no investments and our borrowings remain the same. We have to repay that 33 figure on a monthly basis. All right. Now this month, however, our cash has increased by 33,000 Riyal, which means that our closing cash has increased to 116,000 Riyal. So far, we're in pretty good shape. Let's take a look at the balance sheet. What's happened here? Well, we have created an accounts receivable account. We expect to receive this 50,000 Riyal next month, in the month of January. Our prepaid rent has declined another month. Our property equipment has declined by another month of depreciation, the use of it. Our accounts payable has increased because we have purchased more inventory through credit. And finally, our borrowings have declined by another month of principal repayment. And last but not least, our retained earnings has increased by the amount of our net income. So right now, our balance sheet totals, or our assets and shareholders' equity and liabilities total are equal at 576 odd thousand. Now, let's talk about 4 months of operations. Let's skip down the road a bit. Now, as you can see, our period has increased too long to put to too many periods to put our 3 statements on one sheet. So let's start with the income statement. So now it's the month of February. What has happened? So we have, remember, we have gone ahead and we have that catering contract with that client, and we are going to be paying them they're going to be paying us 50,000 every single month. Okay. So now what's happened is we have gotten a second account in the month of February. So I see that there's a question about how did the accounts payable go up by 25? Please hold that thought. We have one more screen that's going to explain how the working capital has adjusted, okay? So thank you for that question. Just hold it for a minute. So now our cost of sales have gone up proportionally, but all of our other expenses have remained the same. Nothing's really changed here. The only thing is we now have 2 clients for catering, not just one, and our net income, our profit has gone up to 75,000 riyal on a monthly basis. So let's see what happened on the cash flow statement. So on our cash flow statement, we can see that our accounts receivable has, for one, declined by 50, which means we collected 50,000 riyal, and our accounts payable has increased by 25,000. Okay, which means we have more inventory outstanding. We have more payables we have to pay. Okay, and again, we will go into detail in the next slide. Our cash flow from operations has increased slightly. We have no investing activity. So far on our machinery has not malfunctioned. We don't have any maintenance we have to take. Our borrowings remain the same, but now in the month of February, we're doing so well that it's time for us to pay ourselves a dividend, right? We have had 4 profitable months, 4 very good, healthy months, and we decided that it's time to pay the owners a quarterly dividend, okay? And that dividend is going to be half of our cash that we're able to generate from the month of February, including our opening cash balance. So basically, we're going to pay out to ourselves roughly 116,000 riyal in the month of February. Okay, so what does that mean? Our net change in cash is now, for the first time ever, negative, and this is because of that large dividend payment that we want to pay ourselves. Our opening cash, thankfully, was 174,000 riyal, just like we ended with last month. But now we have paid ourselves 116K. So we took all of the cash flows, the positive cash flows we were able to generate from our cash flow from operations, plus some that we had in our bank account at the beginning of the period. We paid ourselves a dividend, and now we have resulted in a closing balance of 116,000 riyal. So this is great. If we look at our balance sheet, we can see our cash balance has declined to 116K, 16-odd-K. Our receivables have increased to 100,000 riyal, because remember, now we have 2 clients in the month of February. Our inventory has remained at a constant 100,000 riyal, which means that over this entire period, we have consistently kept maintaining our inventory at about 100,000 riyal of coffee, milk, cups, etc. And our prepaid rent has accordingly declined by that monthly expense figure. You can see it over the last 5 or so months. Our property equipment, again, has declined by the depreciation amount. And our accounts payable has increased now to 134,000, which means we have purchased more inventory on credit. So we have more payables we have to settle. Okay. Now, our borrowings have also declined by the amount of our principal repayment. And last but not least, our retained earnings has declined to 82,200. Now, remember, we pay out our dividends from our retained earnings. So this is not a big deal. This is not a problem for us. The 82,000 came from our retained earnings from last month, the 124, plus the net income for this period, the 74.7, minus the dividends we paid. So we still have an 82,000 odd riyal of retained earnings. Now our shareholders' equity and liabilities has increased to 603 odd, with its in balance with our assets. So as you can see, our balance sheet must always be in balance. Now let's go into those details, the working capital details. Let's start with our accounts receivable. So essentially what happened was, in the month of December, we had uncollected sales of 50,000 for catering, correct? We did not collect anything, so we had a balance of 50,000 Riyal. The next month, we also had 50,000 more sales, right? Because we did another month of catering. We had those 50,000 that became uncollected, okay? That opening balance is the closing, is our outstanding receivables from last month. Those 50,000 that we didn't get. This month, we sold 50,000 more of our catering, the same client. And this month, they paid us last month's sales. So they paid us last month's catering this month. So as you can see, it's just a 1 month delay in terms of cash collection. So the month of February, remember, we started with the month of January's outstanding receivables, which is our opening balance. Then we had 2 catering clients, and they totaled 100,000 Riyal. We received last month's uncollected sales this month, which means we had an outstanding balance of 100,000 Riyal in the month of February. Okay, so these are the details to the account receivable. Now let's see the details to our inventory. So what happened with the inventory? In the first month, T-0, we purchased 100,000 Riyal of inventory, milk, coffee, cups, etc. We didn't sell anything, so that's 0. And our inventory balance remained at 100,000. In the month of November, we started off with 100,000 Riyal of inventory, again, milk, coffee, etc. We purchased additional inventory of 84,000 Riyal, okay, the amount that we sold, and then we sold 84,000 Riyal. So what we're doing is we are simply trying to keep our inventory balance at 100,000 Riyal by purchasing however much we sold for the period. So we sold 84,000 for the period of November. We purchased 84,000 in the period of November to be ready for the next month. In December, we sold 109,000 of inventory. We purchased 109,000 of inventory. We're simply trying to keep our inventory level at 109,000. Now, finally, our accounts payable. Our accounts payable, this is the credit that we received from our supplier to fund our inventory. So they must be sort of in line. Our 100,000, so we begin with our opening balance, which in the month of October is nil. We increase our accounts payable by the 100,000 of unpaid inventory that we purchased. So the unpaid bills relates to this inventory. And then we didn't pay anything in the month of October. They gave us a 1 month delay. So this inventory, the payables we're going to settle are going to be the following month. So the month of November, we started with 100,000 of IOUs to our supplier. We purchased 84,000 of inventory. So our unpaid bills increases by the 84,000 we purchased. But we also have to pay last month's unpaid bills this month. So this is going to be a cascading effect from November all the way to February. So every month we are either going to be paying more, or we're going to end up with either more or less outstanding accounts payable, depending on how our inventory flows. If we need to purchase more inventory or if we have enough on hand. But as the way the business looks like it's running, we're going to need to keep purchasing inventory because we are growing very, very quickly. So everyone, we have actually just run over our time. We were planning to finish just a few minutes ago. This was our cycle of our understanding the financial statement cycle. I hope that the example we went through really put a grounded understanding about how the financial statements relate, how they work together to give you the results, and how straightforward they can be if you can simplify your understanding of the 3 statements. That's all I have for you today. If you have any questions, please feel free to send them to us at info@viftraining.com. You can visit our website at www.viftraining.com to see all of our course offerings our dates as well as our previous webinars. We do have a large library of e-learnings that I would really suggest you take a look at. If there is anything at all that you need from me or the team, please feel free to send us an email. We love hearing from you guys. You will receive a copy of this webinar via email along with your certificate. Other than that, that's all I have for you today. I hope you enjoyed this webinar from Virginia Webinars, and we hope to hear from you guys soon. Thank you everyone for attending. Have a good weekend.